I'd like to thank everybody for joining me today. Today, I want to talk about premium finance, the ability to use other people's money to fund our life insurance. Now, this is a tool for high net worth, high income clients, but it can be a good tool for the right people. And think about this. If you're going to buy a house, and the cost of the house is $1 million, and you have $1 million in the bank, are you going to use your own money or are you going to finance the home? And when we buy homes, everybody goes and gets a mortgage, even though they have the ability to pay for that. But when it comes to paying for life insurance, everybody thinks, oh, I have to use my own money. Well, think about this. Would you like to use your personal money or would you like to use money from your business? Or does it make sense to borrow the money to finance that premium? There again, why? The ability to keep your money working in your business or to keep it invested, those are things that we want to look at. There again, what's the best answer instead of defaulting just to something that everybody's used to doing? If you look at the benefits of using other people's money, number one is leverage. If you're making a 10% return on your business investments or your personal investments, and it costs you 6% to go borrow the money from the bank to keep your money working and use the bank's money to fund your life insurance, it makes sense. If you also look at, just the potential, with that out-of-pocket savings, just keep things going, use your money maybe to fund the exit, or if we build the life insurance correctly, we can exit, with the cash value in the policy. The other thing, we don't talk about this enough, is just the gift tax opportunities. If you need to maximize your annual and lifetime estate tax exemptions through gifting, let's gift the business those things that are harder to move, or gift real estate. And there again, use the bank's money for the life insurance. The other one, and I think this is more important, is having a lower impact on your assets. If you've got your assets working in your business and you need working capital in your business, and all of a sudden it's like, well, I need life insurance too to fund, your estate planning, liquidity, uh, buy sell agreement, whatever your need is for that life insurance. Well, if we're pulling money away from your operating assets, well, we're going to have a hiccup. And that hiccup could be devastating to your business. It could be devastating to your personal assets. So if it makes sense, keep those assets intact and working. And there again, let's use bank money to handle the life insurance. Finally, it's liquidity. And a lot of times I see this with clients and with prospective clients, is they need to buy the life insurance. The needs there, maybe the bank's requiring it for loans or whatever. You start looking at this, and you need liquidity in your business. You need liquidity in your estate. And all of a sudden, we're pulling that liquid capital away from your business to buy the life insurance. Well, that may not be the best arrangement. There again, you need to keep everything in the right bucket. And if having a set amount of cash for liquidity makes sense, we don't want to take that cash away and lock it up into a life insurance policy. And we don't want to pass on getting the life insurance when it's needed in your planning. And so there again, bank financing using other people's money may be the right thing. Finally, the limitation on cash flow disruption. And if we're talking life insurance, and I don't care if we're talking life insurance, investments, buying other assets, if it upsets your cash flow in such a way that it causes you heartache, well, it probably isn't the best answer. And so if we can start looking at other ways to make sure we fill in your picture, and that's where I like to start with the planning. If we go through the planning and part of your planning says you need life insurance, for liquidity, for buy sell protection, key person protection, estate planning, passing on to your heirs, whatever that is, It's always comes back to we have limited dollars. If we had unlimited money, everybody would buy all the assets and life insurance that they need, but we have limited resources. Cash flow is in for a lot of businesses and planning, cash is king. We got to keep that cash flow there for all of those what ifs that are coming up. And so there again, let's look at the potential of using other people's money in the right situation. So let's look at an illustration here. So it helps us to understand what's going to happen. So in this illustration, we're looking at a 48-year-old male, standard rating, so healthy, not super healthy. If I'm looking at this and we design this and say we're going to put in $500,000 a year, 500,000 a year for premium. So over a 10-year period, we're going to put $5 million into this policy. Now, if the client has 5 million of cash flow available over that 10-year period and they want to write the check and just cash flow it out of their assets or income, great. But if they say, yes, I need this insurance, but that cash flow, that's a problem. And so if the cash flow is a problem, we need to find another way to pay for it, or we've got to reduce the premiums. And if this is what they like, let's look at it. Well, we can go to a bank, and today, 6%, we can probably get a little bit better interest rate than that for most people. But if you look at this at a 6% interest rate over the first 10 years, we start at a very low premium or a low interest. First year, it costs $30,000 in interest costs to pay for that loan. Now, over time, that's going to build up. So by year 10, it's 300,000 a year, still short of the 500,000 per year that the premiums would have cost. So over a 10-year period, instead of taking 5 million from cash flow, it's going to take 1.65 million from cash flow to cover the interest. Now, we want to look at what's the benefit here. Well, the benefit that they're looking is we need a death benefit. For whatever reason in their planning, they've decided they need 13 million and change of coverage. Now, if we look at this policy, if you look at the top, it says policy death benefit net of the lender loan. So if our client here passes away, we want to make sure the loan gets paid off first, they get the net. So they're going to have a little over 13 million, pretty much all of those years. So that fits their insurance need. Now, this all looks good. Borrowing money looks good until we come to the next part. We have to pay it back. So if I look at this and if we're going to pay it back, well, we can take this and at the end of year 15, beginning of year 16, we can take money out of the policy, take cash value out of the policy, take the 5 million that we owed the bank. Now remember, we've been paying off the interest each year, so we don't have a growing principal balance. It's just the money that's borrowed. So we pull 5 million from cash value and we use that 5 million from the policy to pay the bank. So now total interest they've paid over the life of this loan is 3.1 million. They use the cash value from the policy to pay the loan back. The bank's happy, they've got their money. Now we look at it and say, what's the benefit to our client? Well, our client now has $13.75 million that they can use to cover their life insurance need. There again, we've done it more efficient. We've kept their assets going. We've kept their cash flow going in their business so that they can keep growing what they need. And we've covered their debt here, their life insurance using bank financing to cover it. The other thing is the what if. After the debt is paid off, they've got the cash value that they can use for just other what if planning if they ever need to access that cash value. So if you see after they take the 5 million out, they've got, little over $1.5 million to be using for their business, their personal, whatever this is used for. So the thing to remember here, Premium finance is a way to solve the need for the client. They need the insurance. They've identified the need for the insurance. Can we find a better way to help them pay for it? I appreciate everybody getting on. If you have questions, feel free to reach out. If not, we'll talk again next week. Thank you.